Well, hello everyone. Thank you for having me here with you today. As Katya mentioned, I'm Theodora Hadjimichael. I work at Responsible Finance, and I look after policy and research there. We are the membership body for the sector, the responsible finance sector. We have about 50 members operating in this space. And some of you may have known us as Community Finance or CDFIs, and we actually rebranded to Responsible Finance last year, and we feel that the new brand and the new name better reflects what we do, what our members do, and what our role is in the financial services sector. So I'll tell you a bit about the sector, where we fit in, and a bit about how we want to challenge sort of the traditional bank approach. So to tell you a bit about the sector, let's start with why responsible finance is needed. Here we have some statistics and figures which you're probably all quite familiar with and actually aren't that different from what Andy showed us earlier. But essentially, they're telling us that there's still that access to finance is still a significant gap or a significant barrier for a lot of small and micro businesses. And since the financial crisis, we've seen credit conditions improving. We've seen a lot of new entrants in the market, which we've talked about today. But are these improvements and are these new entrants filling the whole gap that was left, particularly after the financial crisis? And here we see that bank declines are still high, especially for small and micro businesses. And also we know, and I think the Nestor report also told us, that a lot of the peer-to-peer lenders and crowdfunders, their lending and even where their investors are from are concentrated in London and the southeast and aren't reaching some of the areas that have faced longer-term underinvestment. And also I think if you look at some of the decline data for peer-to-peer lending and crowdfunding, their decline rates are actually higher than the banks are. So I think what this is pointing to is that, yes, there have been improvements, certainly, but perhaps it's concentrated at the prime end of the SME market, which still leaves a significant gap for a lot of businesses. What this gap is, what this market failure is what responsible finance aims to fill. So what we see the gap is being perhaps more structural than cyclical. Perhaps it's a lot of micro and the S of SME still face I guess more barriers than larger SMEs in accessing finance. There's a gap in accessing below £150,000 for either startup or growth. And then also, I think a lot of businesses that don't have adequate security or aren't particularly in a high growth sector or perhaps have some adverse credit event in their history also face more barriers in accessing finance. And so what the responsible finance sector aims to do is to fill this gap in the market, or at least try to address part of it. So responsible finance providers lend to businesses. They also lend to individuals and social enterprises that can't access finance from mainstream banks. And in doing so, they want to create a positive economic impact, create positive economic outcomes in the local area, and therefore contribute to building stronger local economies in some of the areas that we know aren't receiving investment from other lenders and other investors. So a little bit more about what responsible finance providers actually look like as organizations. So and we like our new logo a lot. So responsible finance providers, they have a responsible purpose. So they are lenders with a social purpose. They're lending into areas of market failure. They are responsible organizations, so they're social enterprises themselves with the legal structures in place that require them to reinvest into their mission. They have responsible products, so they have affordable products. They don't charge high interest rates. And they are all either have received FCA authorization or are going through the process right now and have interim authorization. And finally, they have a responsible approach. So they often provide pre, during, and post business advice and support alongside the finance to help their customers become investment ready and ensure that the finance is able to work for them. And also, I could tell you a bit about the responsible finance model, which is responsible finance providers don't take deposits, so they have to raise all their funding to on-lend externally. Traditionally, they have accessed or secured grants from local, central, and European governments, and often use that to both on-lend, but also to leverage in commercial investment and social investment as well. And I'll get onto this more later, but the availability of grant funding has been decreasing over time. So some policy tools like guarantee schemes or tax reliefs are increasingly important for these organizations to be able to access commercial funding to on-lend that will enable them to expand their reach and reach those markets that are currently underserved, but will make a disproportionate amount of economic impact. So responsible finance, the sector, our members lend about £250 million a year, and that's again to SMEs, social enterprises, personal and consumers, individuals for both household and personal purposes. In the last 10 years, responsible finance providers have lent $1.6 billion to 280,000 customers. And you know, this is an impressive figure, but does it begin to close the gap that we know exists? And unfortunately, it's just a drop in the bucket, really. But it is, it has helped 280,000 people and businesses who would otherwise not be able to access finance elsewhere, and therefore not be able to achieve their household or their business goals. Of this, during the last 10 years, responsible finance providers have financed 50,000 businesses, of which 40,000 were new and starting up. This finance helped those businesses create 68,000 jobs or new jobs, and save a further 41,000 that were at risk without the finance that they received. And this contributed up to this every year. This activity contributes up to 5% of the UK total jobs growth every year. And we've done some research at Responsible Finance, and we've found that for every £1 that our members lend to businesses, they generate £7 in local economic value. And this is additional value. This is additional economic value because otherwise these businesses would not have been able to access finance and make the economic contributions that they have made. So in the last year rather, our members generated an additional just over £500 million in economic value, and this amounted to about 2% of the total GDP growth last year. So where does responsible finance fit in the market? So we've heard a lot about the various players in the ecosystem, and so and you know, where do we fit with all of them? And so this is sort of our interpretation of the financial services system. You know, it's not perfect, and a lot of it is, you know, some of it is illustrative. I mean, we actually think that there's more, the concentration has moved more to this side, and there's a gap around where we sit, which I described before. So essentially, we looked at, you know, we used credit score as a proxy for risk, and interest rate as a proxy for fairness or affordability. And so we think that increasingly, you know, there is more choice, which is good, and more competition, but it's at the lower risk end of the market. And for those businesses that are small or seeking small amounts of finance, or have some credit issue in their past, they have less choice and possibly have to pay more. And there are fewer. We serve that end of the market, but we're sort of alone in that. And just to break down this market segmentation a bit more, so what we've done here is mapped in the West Midlands and a zoom in of Birmingham. We've mapped bank SME lending with responsible finance SME lending and indices of multiple deprivation. And what you can see here is that we are lending where banks are not, and those actually also happen to be areas of higher deprivation. And just a bit more on that. Last year, 86% of businesses that received responsible finance or responsible finance loan had previously applied for bank finance and been formally or informally declined. 35% were women-owned enterprises, 29% were minority-owned businesses, and 16% were businesses under the age of 30. So that gives you a bit more color as to who we're lending to and sort of who are these businesses and micro-entrepreneurs who want to access finance but can't. And then here are a couple of case studies about some recent clients that our members have supported. So we have a serial entrepreneur in Birmingham, started a digital platform and has grown to over 30 staff in a few years after receiving responsible finance. And then we have a plumber one-man band in the Northeast. He has grown to a small team and is offering an important community service important community service to the local area and to local development projects. So both were declined finance from banks. The plumber actually was declined by several banks, but both are examples of viable businesses that were made even more viable by accessing responsible finance and have made an important contribution to their local area. And finally, to talk about the future of the sector and some challenges and opportunities that we face. So first, to start with the challenges, awareness. I think a lot of alternative finance, the alternative finance sector, lack of awareness is generally a challenge for all institutions. Customers or businesses aren't aware of the alternatives to bank finance. They're not aware of how to access them, whether to trust them, whether they'll be around in 3 years or 5 years if they need to access finance again. Another challenge is the sector's ability to scale. The responsible finance sector, it's a relationship-based model. It's often face-to-face. There's a lot of mentoring involved. It's place-based, has a physical presence. This presents a challenge to scaling up and meeting the gap in the market. And finally, access to capital. It's a big challenge for the sector is access to sustainable and affordable capital to on-lend in order to fill this gap. And then in terms of opportunities, so I guess a lot of these opportunities are opportunities to not only the sector itself to scale up and to, I guess, create more of a continuum on that sort of access to finance scale we looked at before, so the customer journey is a lot more smooth, but also there are opportunities to sort of change or look at sort of financial exclusion and address some of the root causes of financial exclusion. So first opportunity we see is devolution and the localism agenda. It's sort of ongoing now and we're learning as we go along, but we see devolution as an opportunity for responsible finance to really be written into or sort of adopted as part of local infrastructure and to be written into local economic development plans. As organizations that really want to stimulate local economic growth and improve the local economy, responsible finance is in a unique position to be involved in building local supply chains, in sort of being the vehicle for local economic investment, whether it's a financial downturn, whether it's flooding, whether it's to address a steel or manufacturing plant that has been closed and workers need to sort of be reintegrated into the labor force. A second opportunity is new technology. So especially in alternative finance, we've seen how technology can really transform and has already really transformed how businesses and people use their money, how they borrow money, and how they manage their money. But again, for a sector that's very relationship-based, new technology presents an opportunity for, and sort of relationship-based and face-to-face model is more expensive because you have to, you have the staff costs. So technology really offers an opportunity for efficiencies, sort of back office services, common loan management systems, even some loan decision-making tools. And also certainly the bank referral platforms that were designated by Treasury in the budget last week certainly offer a way for SMEs and micro-enterprises that were declined bank finance to be connected and linked to alternative providers and non-bank providers like us that they previously would not have known about. And also, a lot of these sort of savings and efficiencies, they enable responsible finance providers to allocate their resources in different ways, whether it's to providing high quality business advice and support, or to reaching those customers who might be digitally excluded, and it takes a bit more work. And then finally, sort of some opportunities that can help us get over the access to capital hurdle. So, I talked about grant funding going away, but there's still a lot of opportunities with policy guarantees. So existing programs like the Enterprise Finance Guarantee, EFG, tax reliefs like the Community Investment Tax Relief, or CITR, are both really good incentives for leveraging commercial investment into the sector. We would like to see those become more competitive and more fit for purpose, but we'd also be really interested in seeing local areas adopting guarantee schemes and tax reliefs that could encourage more local investment. And sort of on the back of that, obviously, crowdfunding and the crowd-based model is a really good opportunity for generating local investment into local projects. And so I think, we've seen a bit of that. Andy talked about the funding circle model with local councils, but I think combined with policy guarantees, and sort of being able to leverage in crowd investment is an opportunity for local investors to lend or to invest in some of the more high risk or excluded micro-entrepreneurs in their areas. And then finally, we see a lot of opportunity for collaboration. So obviously, we're here today and hope to be able to engage with all of you more. But we also see collaboration with collaborative opportunities with some other local institutions that serve similar market segments. So, institutions like credit unions, housing associations, enterprise agencies that all operate in a similar market, but often operate in silos. So we see opportunities for working together more, sharing back office services, and being able to share assets to provide sort of a wraparound service for our customers. And we think that sort of together, all of these things, having really effective policy guarantee mechanisms coupled with a crowd-based model and sort of a local institution or local banking type model is a really exciting future for the sector to be capitalized sustainably and be able to lend to those businesses in those markets that are currently excluded from mainstream. So I think that's all I have for you today. So thanks for listening, and happy to take any questions that you may have.